Well, the last time I did a meta video, I was joking about the bottom being in when Jim Cramer was crying on television, and it actually turned out to be true. So here we are with meta at 212, up 150% from the bottom just 6 months ago. This is crazy, and I'm going to go into the sentiment that surrounds this stock in this video. I also have some notes on just general meta things to look out for later on in the video. But first, I want to say that I did sell 50% of my stake here in Meta, so I'm up from about 127 to 212, and that's a 67% gain. So I took half my position off the table here, and I just wanted to let you guys know that. Now, I think just generally on why I sold, one, I think that the market does not go in a straight line forever. This thing's up 150% from the bottom, and I assume there's going to be profit taking at some point. That might be wrong. It could go to 300 in a straight line. But generally, I think there are pullbacks on stocks. So if it comes back down again, I'll add. I also think that currently the stock is more fairly priced than it was 6 months ago, and it is not screaming buy cheap stock anymore. I think 10% adjusted EPS for 2022 and a price over 200, you're at about 20 times earnings, 21 I guess right now. And I think that's a fair price for a company like Meta with a bunch of huge moats and good long-term upside. I should mention also in this rate environment. Now, if we had lower interest rates, it might be worth more than this, but I think we have to take into account that the Fed funds rate is around 5%, and that is a factor here. Okay, let's talk about sentiment. This stock is a sentiment stock. It is a wonderful business, and there are so many people looking at this stock and analyzing it that it is very difficult to get an advantage on Meta by reading financial statements and looking at the transcript or listening to the earnings calls. I was reading Nick Sleep's letters recently, about halfway through, and it's quite interesting. So I recommend that to anybody who is curious. But one of the things he brings up was Bill Miller's view on the ways you can get a competitive advantage in stocks or in the stock market. So he has 3 ways that he thinks you can get an advantage. One is informational. So like, I know something that other people don't know. Very difficult with Meta unless you're on the inside and you have some information that nobody else has. But like I said, there's a lot of people reading these financial statements and their annual letters and stuff, and it's very hard to find pieces that other people don't know. You can have an analytical advantage as the second way of having a competitive advantage or an edge, and that is that I cut up public information and I arrive at a different, superior conclusion to the majority, right? Whatever the majority is pricing into the stock, and you have to figure that out too. Also quite difficult with Meta because there are a lot of smart people out there. There's a lot of Harvard PhDs and Columbia grads that are cutting up the same information. And these are smart people, and I personally don't think I'm smarter than most of them. So that leaves us with the final advantage you can have, which is psychological. So psychological this is basically behavioral advantage. So I went through the history of all the problems that Meta has had over the last 10 years. And I think this, back in November, this was about the seventh or eighth time that Meta was pronounced dead by the market in general. And if you had bought any of those times where Meta was pronounced dead over the last 10 years, you would have made money. Those are the behavioral bottoms for this stock. Okay, so if you just buy the misery and sell the euphoria, you can do really well in this stock. And I've played that cycle, I think, 3 times now. So let's go back and look at what happened in after quarter 3. last year. The entire market was miserable about this stock. It got sold all the way down below 90. And the general idea here that I got from what I was hearing, what I was reading, was that Mark Zuckerberg's lost it. He is stupid. He doesn't care about money, and he's sinking the company via his metaverse pet project spend. People couldn't see anything except that viewpoint, right? I'm sure a lot of people did, but that was the consensus view, and the stock totally got sold off. So at that point, then I thought, okay, this is just another one of those cycles. Meta is, they're quite a strong company historically, and they usually overcome these problems. In fact, they've overcome all of them to date. Now, if we look at just prior to Q1 release, which is, I'm at April 24th right now, and the earnings are coming out this week. I find nothing but euphoria here about this stock. I see everyone talking about how there's a TikTok ban coming, and that's going to be great for Meta. The year of efficiency that they've talked about, they're cutting costs. They are making the company more efficient to increase the margins again. Everyone's excited about that. Reels, AI, you name it, there's positivity around this stock. And it seems like everybody has actually forgotten about the metaverse, which I find totally insane, right? So they couldn't see any of that stuff before, even though the company was cutting jobs just after Q3 last year. Nobody paid attention to it. And the only thing people could see is the metaverse. Now nobody sees the metaverse and everybody sees the other stuff. This is insane, right? So now what I'm doing is I am selling half my position into the euphoria here, and maybe I'll get another chance when everybody hates Zuckerberg again. Now, I want to talk a little bit about Cramer here. So Jim Cramer is, to me, he is sentiment. He is Mr. Market. Ben Graham talks about Mr. Market, where sometimes he's euphoric and pays huge amounts for the shares you own. You can sell to him, and sometimes he is miserable and depressed, and you buy from him. So I think that Cramer is the human embodiment of Mr. Market, and that's why I watch him, because I think it gives me some kind of a sentiment advantage, plus other things I do. This isn't the only sentiment indicator I have, but he is quite a good gauge. And so if we look at some of the tweets he's put out over the last 6 months, prior to Q3, he said nobody is respecting the stock. Q3 comes out a few days later, and he says, "Oh my God, this management team screwed me. I can't believe I trusted them. Sell." And now we're back into, "Oh my God, TikTok is going. This is going to make." I don't know. He loves the TikTok thing. He's back on the Meta train, and this is insane. So if you have not found the Inverse Cramer Twitter account, I suggest following it, because it's quite interesting. Okay, so let me just add a few more points on this subject of sentiment. So, like I said, the predominant view I think that the market had was that Mark Zuckerberg didn't care about burning cash. He didn't care about money, and he totally had the blinders on. Now, if we look at the history of this company, I think there's a lot of proof that he does care about money, and he continues to care about it. So I think that was a perfect example of a time where you could really call the market stupidity, okay? So if we look at the 10-year results from Meta, their net margin for the company is over 30% most years. Now, they had a bad year, and they only had 20% margin last year. Net margin, oh, what a disaster, right? Any company that turns out a 20% profit margin in a bad year is a great business. We also see the return on capital. So the return on equity last year in this terrible year was 18.5%. Anything above 15 is fantastic, right? So, I don't think that they got these results by accident. Mark Zuckerberg, I think maybe underlying it is that Mark Zuckerberg, people believe that he got lucky, right? Oh, he created these moats. He was just lucky because he was the first mover. The guy is a genius. He saw that opportunity was available. He created that opportunity, and now he's defended these huge margins for 10 years. That's not an accident. This guy wants to win, and winning, part of it is money to him, right? If we look, and then if you pull apart the idea that, okay, it's social media, so they're supposed to have huge margins. Snapchat doesn't make any money. TikTok doesn't make any money. Go look at their results. This is not easy to turn out these kind of results, these kind of returns on capital and margins. Now, in addition to that, I pointed this out in the last video, they were talking about their CapEx, and people were worried about this huge CapEx spend. But they said very clearly, we have a very clear hurdle rate that we look for on our return on capital, on our CapEx spend, right? And that is presumably what's going on with the metaverse spend. They see that it's going to create income in the future. That's the goal. And they said if they don't believe that that return is going to be there, they will cut the spend. So these big CapEx spends, which actually came down, the guidance in quarter 4 came down, or the guidance for 2023 came down. I think the market liked that. But if they're going to make money, that's what we want them to do. We want them to have big CapEx spend. If they're going to get, 18% return on their capital, more 20, 25 return, that's what we want. We want them to take this huge cash pile and invest it for future returns. Okay, now I'm just going to point out a few bits from quarter 2 and other things that I just wanted to point out for anybody who's interested in sort of more broad stuff with Meta. Now, if we look at 2022 free cash flow, it is at 19 billion, but they have their share-based compensation that gets pulled out of that, and that's 12 billion. And then they go into the market and buy those 12 billion in shares back, plus some more for their buybacks. Now, this is a little bit of a trick because I think that those share-based comps should actually be included in their free cash flow because they're actually paying cash for those. So if you take the 12 billion out, their free cash flow for last year was actually only 7 billion. And that is not great on a $550 billion market cap. So I believe the stock actually, or the company actually isn't as cheap as it may appear at first glance. On the other side, I don't think the market cares about that. I don't think that they're looking at that. I don't think people notice when that happens. So maybe that's irrelevant from a stock price perspective. But if you're owning the business, you would say, well, it's only spitting out 7 billion last year. So hopefully that is the bottom year, and they're able to expand free cash flow going forward. But we don't have a huge amount of visibility into what that looks like. If we look at earnings for last year, if we take out the adjustments for the restructuring, they actually landed at $10 per share. So that's a good result, and shows that it's not as big as a disaster as the market maybe thought it was halfway through the year or after quarter 3 when they actually posted 0 free cash flow. So, two different indicators there. One is maybe positive and one maybe not positive. Some other things that have happened recently, on this side of the year, WhatsApp payments went live in Brazil. Now, this is one more step towards WhatsApp becoming a super app, maybe like WeChat. So I'm interested to see how that plays out if they start generating good revenue from WhatsApp and their click to message businesses. I think WhatsApp has a lot of upside here. On top of that, Reels also has a huge amount of upside. And with their new AI investment, I think the upside is quite good. I just don't know how that's actually going to play out and how many years that's going to take. But I think there's still a big runway here for revenue and earnings growth via those two paths. And that's not to mention the metaverse spend. Actually, I'm one of the only people I think that actually likes the metaverse spend. I think that out of their 4 projects there, they're going to hit at least one, going to get at least one win. And I think they might get 2, right? Oculus looks like it's working. They are the leader in that space, and that is going to be huge if businesses start buying those headsets for their staff instead of sending them on business trips, right? That's a big deal. like I said before, I own a company and I run a company, and that is definitely something I would consider doing, because basically it just takes one trip and you've paid the headset off, and you probably save on other trips. And if that improves the company culture for online meetings, I think that's a win for everyone. Now, one other note from, actually there's a few notes here, from Q4, the price per ad dropped 22% and impressions were up 23%. So there's kind of offset. But the price drop over 20% shows that I think we are in the recessionary environment for a company like Meta that relies on advertising. So to expand that view, if $10 per earning or $10 per share is the bottom tick, is the low period or the low year for earnings, that is a great sign going forward, because if we get an economic expansion that's broad-based, the earnings could go up quite a lot as these prices per ad go up again. They on buybacks, they said that they spent $6.9 billion, and they've upped the cap to $50 billion overall. Now, just keep in mind that $6.9 billion, $3 billion of that was just buying back for the share incentive or the employee incentive plans, and so the net buyback is actually only $4 billion, and for the year, it is less than it appears to, because they bought $12 billion back for the employees. So that is interesting. But if they buy back another $50 billion, let's say $20 billion of that goes to employee share plans, then you've got $30 billion, which is about, just over 5% of the float available. Again, the year of efficiency, that's actually great news. I like when companies go through tough times, because they get lean, they get mean, and then when they come out of the recessionary period, they are ready to rock, and the margins end up potentially being higher than they were going into the recession. So this is actually good if you're a long-term holder for Meta. Maybe that's it. Oh no, we'll talk about the guidance. So if I post if I show the guidance here for the next bunch of years, in 3 years, the guidance is showing about $15 per share. Now, what I'm noticing here is that the range of estimates is pretty wide, which makes me think that nobody really has good insight into what the earnings are going to look like here. So that is part of the risk with Meta, is that it's very difficult to forecast their earnings, but it's also part of the upside too, because you can get unexpected beats and wins as you go along. Well, that's it. And all in all, for me, I just want to say that I still think this is a great business. They still have 3 moats that are impenetrable. They still have huge amounts of revenue and profit upside here via, Reels, WhatsApp, AI, and the metaverse. And some of those will definitely work. So what I'm doing is I'm taking half my position off the table, taking the profits that I've gained over the last 6 months, and I'm going to look for a reaction down in this stock at some point. I don't know when that's going to happen, but based on the history of this company, I think it's coming at some point. So I will wait till everyone is miserable again, and then maybe I'll pile back in. All right, guys, thanks for watching. If you got this far, we'll catch you in the next video.